All right, welcome to Outlier University. This is where we teach you to save time, make money, and start winning with less risk. So go ahead and subscribe if you're watching the replay and you haven't done so already. Now, Outlier University is provided 100% for free. The only thing you have to do is subscribe. So week 4, managing money like a pro. Now, we've talked in week 1, the foundations of trading. Week 2, thinking like a successful trader. Week 3, developing your trading plan. And week 4, sharing those back-tested results. That was great. Week 5, that's where we're on right now. The last class we talked about what is money management, and this class we're going to start with Monte Carlo. I added that into it, and I want to discuss what Monte Carlos are. Computing position sizing from our risk percentage, and then the rules for risk management and survival. Now I'm going to ask you guys for some of those rules later on, so think about that as we're going. So a couple of quotes I wanted to show up front. This is one of my mentors, Mark Minervini, twice champion of the U.S. Investing Championship, 1997, 2021. He says, based on the feedback I'm hearing, it seems that traders are more fearful of missing a great opportunity than they are of volatility and more downside risk. Amateurs are concerned with missing out on the upside. All right, now follow along. This was on purpose. Amateurs are concerned about missing out on the upside. They focus on the money, and they hate to take losses or sell too early. Pros focus on managing risk, implementing processes, and maintaining the discipline needed to consistently execute their plan, knowing that if they get those right, the money takes care of itself. Now, I would actually like to get y'all's feedback. Reading a quote like this is actually super profound, but a lot of people would have glanced right over this without any second thought. How does this read to you? What are your takeaways from this? Go ahead, Stocky Locky.
So, I said yesterday, I mentioned about the gone blank there. When we were talking about the risk side of things, I was saying initially there was no plan made, and everything's YOLO, and we're just going to go straight in without appreciating what's involved. And that's similar at that same time. That's kind of the thing you look to as an amateur, is you look to just get the gains. You just want the gains. You just want to win all the time. But you never ever think, in the early days certainly, that you've got to manage that risk aspect, the loss.
Right. We're going to talk about this in a little bit, but I think you nailed the part on the head that I'm looking for, is that winning is an unavoidable part of trading. Oh man, winning is such an exciting, unavoidable part of trading. If you're trading, you're going to win. That is a fact. But losing is also an unavoidable part of trading. Some people on the internets would say you don't have to lose. Just double down. Just double down and blow up your account. It'll be fine until $50 million vanishes, okay? It'll be fine to just hold on to a stock until it comes back to break even. You never actually have to take a loss if you never close the trade, right? It's just paper loss. It's not a real loss until you close it. None of that's true, right? If a trade is not working out and it shows you on the chart, which leads into this, if it shows you it's not working out, you have to understand that you will absolutely get yourself caught in a situation where things get worse and worse and worse. Because if it's going to work out for you, if it's going to end up being a winning trade, it's going to be a winning trade right out of the bat. All right. You're going to give it some room to breathe. But if it takes out your stop, who knows how far it can go? I was thinking about this the other day because, we don't buy the dip because we don't know how far down it can dip, right? You don't want to buy stocks as they're crashing down because you don't know how far down it's going to crash. And then I don't know why all of a sudden I started thinking about the opposite. If you buy stocks that are crashing up, you don't know how high they can crash up, right? So why are we buying it on the way down when we don't know how far it's going to go down, when we can buy it on the way up and we don't know how far it's going to go up? Right? That's a different mindset shit. I don't know why I never thought about that, but it's the truth. Buy stocks as they're crashing up, not as they're crashing down. And if your stock is crashing down and you see it and you don't take your loss, you're going to get caught in a situation where things get worse and worse and worse. If you are getting to the point where it's hit your exit signal, it has already invalidated your trade thesis. And that's okay. That is perfectly okay. There is no shame in losing trades. There is a lot of shame in doubling down, adding money to it, and making things worse. Now, we're going to talk about Monte Carlo simulators. What is a Monte Carlo? ChatGPT defines it as a Monte Carlo simulation is a quantitative modeling technique that evaluates uncertainty and risk. by running a large number of randomized scenarios to estimate the range and probability of possible outcomes. So instead of asking, what is the single most likely outcome, we can say, what outcomes are possible and how often do they occur? Right. So we worked on our trading plans, right? And of course, your trading plan is going to evolve 1,000 times before you're ready to call it a day. Because of that, I like to continuously go back to Monte Carlo simulator because I want to make sure that what is the single most likely outcome turns into what outcomes are possible. What are the outcomes that are possible here if I trade this plan? Now, when you have that plan never involves panic selling. Not once. That plan never involves FOMOing into a stock because you heard about it. Right? Your brother-in-law is like, oh man, you got to buy this stock. It's so great. Never, ever, ever does your plan involve that. Now, here's the thing, is that you could write the rules in a newspaper. You could put an ad in the Wall Street Journal for everyone to see, but nobody would follow those rules with consistency and discipline. I made that up. Nobody else in the history of time has ever said that quote. I will take full credit for that. And because of that, nobody in the history of time can be successful trading when they abandon their plans and go rogue like that. All right. We're not trying to go rogue. We're trying to follow the statistical edge that we have already worked on, we've already created, and any deviation from the plan removes your edge. Does that make sense? We got it? Okay. So let's keep going here. So this is a Monte Carlo simulator that I like to use. The goal here is for your worst case scenario. You've probably heard me say this before, but the goal is for your worst case scenario to still be wildly profitable. Now think about that. I'm not looking for the best case scenario because you know what? Unlikely to have every trade turn into a winner. Unlikely for that to happen. I'm not looking for the average scenario because, you know, that's just average. I'm trying to figure out if all hell breaks loose, if the shit actually hits the fan, how bad is it going to get? And if my worst case outcome is that I'm still wildly profitable, let's go. Bring it all day, every day. That is the mindset you need to have as you're building your trading plans. I want my worst case outcome to still be wildly profitable. Now, how do we measure this? Let's go do that right now. So this link, you can use that link right there. This is the link of that. And here's what's really cool about this. We can plug in our actually back-tested, actually proven, actual trading plan right here. And it's going to be so sick. Check this out. Go here. We're going to say, okay, over 7,000 trades of backtesting, we found our average win rate to be 56.9%. So we can come over here and we can put 56.9%. All right. Let me zoom in a little bit, make this a little bit easier to see. All right, 56.9%. So that means 43.1% of the time we're going to lose. Remember, losses are an unavoidable part of trading, just like winners are an unavoidable part of trading. If you can't build losses into your plan, you don't have a plan. Now, we can do this a couple different ways. First, average win percent and average loss percent. I actually like to do it in dollars, but we'll do it in percents too. So 7271. All right, hear me out. If I win, let's say I win 7271, okay? And if I lose, let's say I lose 4409. All right, that's the average gain, average loss, 4409. We'll do it in percents in just a minute, but I want to prove a point here. We don't have to worry about commissions, but we can see right off the bat, we have positive expectancy. All right, here's, I'm calling names. Carol, what is expectancy and what does it mean?
It's basically the average win rate minus the average loss rate. So it's your expectancy of wins or the outcome. Yeah. So that could be on the win or loss side.
Exactly. It's your edge. It's your edge like a casino has an edge, right? This right here with no tweaks has an edge of $2,200. Now let's run 1,000 simulations. And let's say that over the course of the year that you could only trade 75 times, because that's honestly a realistic number. That's pretty much where I've landed the last few years. And let's hit run. So this is going to run. All this magic is happening in the background. And we can see here. All right. So if we started with $0, remember, $0 is where we started. Our max outcome, final equity, $333,000. That's crazy, right? Now, our average outcome is $177,000. But our worst case outcome, man, that didn't work out so well, actually, negative 5,000. But I would bet you if we increase this to, I don't know, 500 trades or 365, that's where the base case was, 365, and hit run, that's going to come up with a different number. Now remember, each time this, it does 1,000 different iterations. But the more trades you take, and this is the point that I wanted to make, the more trades you take, the closer you get to that expectancy, even in your worst case outcome. Because here we've taken more trades than the 75, and now our worst case is $367,000, which is crazy, right? Starting at 0 and ending at $367,000. And let's even go back to that. Let's go back to 75. Give or take, let's say 70. Oh, we'll do 100. That's fine. Right. Every time we run this, it's going to be a little bit different. And here, this shows we started at 0 and ended up with $21,000. That's not too shabby, ending up with $21,000. All right. Now let's change this over to equity percent. So if for every win that we do, oh, hang on, where is this slide at? Here, average win, 7.27%. Let's say that our account grows by 7.27%. Let's say that every loss we take, the account falls by 4.409%. Okay, 4.409%. And let's say we're starting at just $10,000, just 10,000. Still positive expectancy. Okay, hit run, still with 100 trades. Where does that go? Now we're talking. Now this is where you can see the compounding in effect. All right. So we see here, starting at 10,000, going 100 trades, and the absolute best case outcome. This is crazy talk. Absolute best case outcome, nearly $600,000 following Plan M on 100 trades. This is crazy talk. This is the kind of talk that fake gurus do, right? Taking $10,000 and turning it into $600,000 in the span of basically 1 year of trading. That's crazy talk. I would never recommend you to ever look for the max. The average is taking 10,000. That's not 100,000. That is 10,000. The average result on Plan M on 100 trades would be $93,000. I don't know. I feel like that's pretty good. I feel like the average result showing like basically 9xing your account in 100 trades, the average result, I would feel like that's pretty good. What's up, Shane?
Yeah, with Plan M, how long roughly does it take you to put on 93 trades?
Well, that's the thing, is that like every time that there are days where Plan M sets up, it's going to be more than one trade, more likely. So it's taking multiple trades in a single day, right? And you've seen I've had as many as 12 on in a single time. And not all 12 are going to be winners, but let's keep going, right? Because over 100 trades every year, that's very realistic. That's pretty much in the ballpark of where I've traded several years in a row now. Now, let's say our worst case scenario. We started at $10,000 and our worst case scenario is no, that's not 1.8. That's 18% return. Yeah, 18% return. That's not too shabby. So you're telling me the worst case outcome here is that we beat the market average by maybe double. The average outcome here, now granted, I am not saying that Plan M is going to average everybody who trades it a 9x in their account. I'm not saying that. All I'm saying is the math behind it, okay? Shows a 9x return. And this over here is just absolutely crazy. But also look at this. Simulation win streaks. 18. And the best case outcome still had a 16 trade losing streak and was the best case outcome. On average, a 7 win streak and a 5 trade outcome. And our worst case scenario had a 3 and a 2. This is crazy talk. Let's just run it again. Just run it again. Why not? All right. Numbers changed a little bit. Now we had a 30%, 33% gain, a 33% gain in our worst case outcome. Pretty much in the same ballpark for average. I feel like this is in the same ballpark for best case, but still an 11 trade loss streak. This is super exciting. This is what Scott and I worked on over and over and over. As I said, plug it in. How are we going to do? Plug it in. How's it going to go? Right now, granted, not every trade is going to be on average a 7% gain to your account. Not every loss is going to be a 4% loss to your account. It might be, I don't know. But at the end of the year, we'll have those numbers, right? So I think this is great. Do you guys see the value of, we worked on our back testing plan, we have the expectancy, and then we take the historical results and we throw this into a simulator and say, how bad can it get? That's what we're looking for here. Everybody got that? Give me a thumbs up if you got that. Cool. Do you have any questions before we move on? What's up, Mark?
So how does this dovetail into risk? Like we talked about Kelly Criterion and whatnot last time. So the more trades you have, the more likely the outcome. But if you have, like, say the USIC account, right? You have $50,000 in the USIC account and you're trading that at 6% versus other people that are trading at 2%. Obviously, you can't put on as many trades. How does that, is there a way to quantify how that balances and kind of washes out? And how do you make that, does that enter into the decision to percent risk in a way with like how do you balance that? You know, because you want trades, but you also want risk, less risk.
So the way that I've always felt is trade bigger with a tighter stop. Now we've actually proven out in the data that you could have a trade bigger with a tighter stop. But you could actually have a little bit of a wider stop, a 2 ATR stop, which we are going to get to. Don't worry about that. And it can still have crazy returns. So don't worry, man. I got you. This is all part of the plan, right? The plan here, you've got a plan. You figured out what your position size is, your bet size, right? We did that last time. Now you're taking your plan and you're putting it into the Monte Carlo to see if this is going to work, right? Over a series of events. How many losses can we handle, kind of thing. But don't worry, Mark. I got you. Let's keep going. So your worst case scenario, we still want to be wildly profitable. Now, you saw that the worst case scenario in multiple versions of that, we're somewhere in the ballpark of like a 30% gain for the year, maybe an 11% gain for the year, right? We don't know where it's going to end up, but I can tell you one thing. This does not include any sort of deviation from the plan. If you're going to run a plan with an edge and you deviate from the plan doesn't exist. So keep that in mind. If it's not there, if the wildly successful outcome is not there, you need to figure out, number one, how can I increase my win rate? Where can I look to find the winners? Any way that I can increase my win rate. How can I increase my average win? Right? That's important, of course, but you probably won't believe that. But this is the most important part. How can I decrease my average loss? This right there is the most important part. Because this losses work against you exponentially. Let's I want to pull up a different slide for this right here. This. All right, a 10% loss takes 11% to get back to break even. A 20% loss requires a 25% gain to get back to break even. A 50% loss requires a 100% gain to get back to break even. And 90% loss requires a 900% gain to get back to break even. Huge gains aren't easy, and big losers destroy capital. So at all cost, number one most important thing is to avoid big losses. Number one thing, avoid big losses. So at this point, you got a solid plan. You've tested your entry and exit signals. You've maximized your plan using the Monte Carlo simulator, which you guys will work on that later on, so don't stress. Now let's calculate the position sizing. Going back to what Mark was asking, right? How do we compute the position sizing to get to our risk percentage? Okay, so we have a plan. We've proven that the plan works multiple times over using math. No trust me, bros, right? How do we get our position sizing? 90% of traders have no idea about this concept. They just are like, let's buy a stock. How much? I don't know. A bunch. A bunch is a great number of stock. Yes. How many calls should I buy? All of them. I'll buy any calls that are available. I'll buy them right now. Trust me, I've done that. 90% of traders have no idea about keeping their risk consistent across stocks. Now, why do we keep our risk consistent across stocks? This all ties together. Because if we keep our risk consistent, our average loss consistent, then this will fit into the mathematical model we built. Is this making sense? Y'all follow along? We don't care how big the wins get. Wins can get out of control. The risk is what matters. If we can control the risk, then we can more closely mimic the risk portion of this profile. Pretty cool, right? Keeping your risk consistent is what we're trying to do. Now, by using ATR, average true range, which is a volatility measure, we can always account for the volatility and make it the same risk. And remember, we're focusing on risk and not reward. So you have two tools for risk management. These can only work if you've created a trading plan and you figured out how to follow that plan without any sort of deviation. Number one is position sizing. And number two is your stop loss. Okay. Your position sizing will save you even when a trade goes sideways, like VKTX. When they release results that are their GLP-1 medication performs great, but not great enough, and it's down 40% the next day, there's nothing you can do. It gaps straight through the stop loss. The only thing that can save your account is position sizing. That's it. And if you went into a trade saying, I don't know, I'll buy all of it, you're effed. You're royally effed. King Charles has called you up and he said, hey, guess what? You're royally effed. That's how royally you got effed. But both of these can be calculated automagically. So this is the formula that I learned from Larry Hite. You've seen this before. Shane helped me make it look beautiful, right? Was that you, Shane? No? Oh, it must have been a different Shane. My bad. Okay. A different Shane helped me make this look beautiful. And you take your account balance and you multiply it by the risk percent that you're willing to take, and you divide that by 2 times the ATR. And that'll give you the number of shares. Now, you can trade that. That's fine. You don't have to do any other steps. But let's say you want to take options because you understand the capital efficiency with options. And trust me, we'll dive way deep into options later in a couple weeks. You take the number of shares and you divide it by the delta that you trade. Now, the delta may be 20. If you trade 20 deltas, that's on you. I don't care. If you trade 50 deltas, that's fine. Figure out what that is for you and trade with that. And then that'll give you the number of option contracts to buy. So example calculation takes 100,000 times 5% of risk, and then you're dividing it by 2 times the ATR at $1.50, gives you 1,666 shares. If you take that number of shares and you're using an 80 delta and you divide that, that'll give you 20 option contracts. We're going to round. Of course, you're not going to get partial contracts, but that'll give us 20 option contracts. So let's take it a step further. Where are we getting these numbers from? The Kelly Criterion. Here you go, Mark. I got you, dude. I had this. I've done this more than once, my friend. Your Kelly Criterion filters into your risk percent. Okay. Now, of course, I am not telling you to go full Kelly. Never go full Kelly, right? That is as close to the never go simple Jack that I will ever do. If you guys know, you know, from Tropic Thunder, never go full Kelly. Okay. But you could do quarter Kelly, you could do eighth Kelly, something like that. Figure out what works for you and go with that. Next, the 2 ATR in this case is my back-tested stop loss dollar. Okay, stop loss dollar, and we'll talk about that in a minute. This is not a random number. This is the denominator that is held consistent across all the trades. That way we can make sure we have a consistent amount of risk. You're gonna love when I show the calculations in just a minute, how we can get it down to the penny on any stock. It doesn't matter what stock it is. We will get exactly down to the penny. Hang on. I feel like I need to do this. Why not? It just felt like I needed a pro tip. I don't know why. So let's keep going. Now, everything is auto-calculated inside of the portfolio manager that we provide. Now, if you're watching this on the replay, down below, you will see my exact portfolio manager. This exact file is down in the description below. You can click it and view it, but you can also come over here and file, make a copy, and then you will have this as well. OVTLYR is doing our very best to make anybody successful. Okay. We want you to be successful, and then you'll be an outlier. It just makes perfect sense. So down here, position sizing dashboard, you can add any stock you want. Now, a lot of stocks are actually in a downtrend right now, like AMD. AMD, the advanced money destroyer, is advancing and destroying lots of accounts right now because it is under the 10 EMA. It's going to light up red, and it's not going to fill up anything for you. We don't want you to buy stocks in downtrends. Because we don't want you to buy stocks in downtrends, we're not even going to show you what that would be. Okay. So I filtered through this earlier and came up with several names that we could look at. MicroStrategy, Amazon, Visa. Oh, geez. Cheesecake Factory. Oh, no, I've totally effed up everything. Oh, no, I broke it. Hang on. Oh, no. Totally jacked it up. It's ruined. My entire career is over. I'm going to have a 2-hour-long video written about how Chris is a fake guru because oh man, this will not undo what I did. Oh, dang. Okay, that's great. This is live, so we're going to continue on. I'll fix it later. So we're going to go with these. That was great. Awesome. Like I say, this is down below forever. I did simple jack that. Thank you, Shane. I simple jacked that real hard. Thank you very much. Okay, so we're going to look at this, and we are going to do the calculation the old school manual way, taking our account balance and multiplying it by our risk percent. So you could, let's just say your risk percent's 1%. There's nothing wrong with 1%. This is going to drive me crazy. I have to delete the whole row. We'll get it back. Don't worry. Oh, you know what? I can do a previous version. It'll be fine. But for this example, since we're live, let me continue. So let's say you risk 1%. So you're going to take your account balance. In this case, this is automatically populated for the account balance for the U.S. Investing Fund, 50,343 times 1%. Okay, so that's step one. Multiply your account balance times your risk percent. Then you divide by 2 times the ATR. This automatically pulls in the ATR value for you. You can do this on your own on any chart. Just go and add an indicator called ATR. Where's my ATRs? I am all kinds of not on top of things today. Where the heck is my ATR? Restore pane? There it is. Okay. This is the ATR value. You can add this on any chart. It's free for like everybody, but ATR measures the volatility of that stock. What's really cool about this is you can take 2 wildly different stocks. Let's do Cheesecake Factory and Celsius. All right. So both of these are around $50. And the ATR for both of them is around $1.50, which is actually not that far off. Let's go to silver. Silver is around $70, but the ATR is more than double. So it's about $20 more, but about double the ATR value, the volatility of it. Okay, so what do we do next? Well, we divide by 2 times that number, and that will get us our share size. So let's do the math together. Ready? Let's take a calculator, and let's say our account balance, 50,343, times our risk percent, 1% times 0.01, gives us 50,303.43. Okay, that's how much, or 503.43. That in dollars is how much we are willing to risk. This is our risk in dollars. Does everybody understand that? Let's take it a step further. And we divide by 2 times the ATR. So the ATR value is $1.51 here. So we're going to divide by 301 because that's this times this with a bit of rounding. Divided by 3.01 gives us 167 shares. There you go. It's not that complicated. Now, this is the amount of risk you're taking per share to get to that stop loss point. You get to determine what that stop loss is, right? If you say, that's the wrong button. If you want 1 ATR, that's fine. But to say, I only want to take $5, $5 is 10% of this stock. $5 is 1% of this stock, give or take. $5 is meaningless. When you use ATR, it always takes into account the volatility of a stock. So we're measuring the volatility and we're saying, okay, 2 ATR ranges going against us will prove that this trade is not going to work. Does that make sense to everybody? If it goes down by 2 ATRs, it has proven to us it's not going to work. It's okay to get out. Until that point, we can hold it. We're looking for any other exit signal. So we've covered this and everything is automatically calculated. So let's do this. I'm going to insert a column. I'm going to widen this out. And we're going to do a little exercise here. And we're going to say, okay, how much risk am I willing to take on each one? If I take 167 shares times the current price, oh, no, that's the wrong thing, times this, we should get $503. And we apply that down, and every single one comes to the same $503. That's 1%. Let's change it to 5%. Every single one comes to the same, to the penny amount of risk. This is what we're trying to keep consistent so that we can get consistent results in our average loss so that our wins can be huge, but we keep our losses, the part that works against us, small. Everybody tracking? Everybody see what we're doing here? See how this is, it's not just, hey, buy the stock. There's so much that goes into it. This is what a comprehensive trading plan looks like and why we do it this way. So let's keep going here. And let's take another look, and we can see that even though this has an ATR, 2 ATR value of $12, it's still $2,500 in risk. Or in this case, if we went back to 1%, it's still $503 in risk. Every single time, it always comes through the same thing. Now, that is with the assumption that we get out with this much risk, taking your current price, subtracting out 2 ATRs, and getting out exactly there. Let me continue on with the slides because I know I have more slides for this. So how does it work? We're backing into the number of shares that would get us to the max risk. So we know how much risk in dollars we're willing to take. How many shares does it take for us to get to that point? That's what we're doing here. So in theory, if we get out at the exact penny of our stop loss, that is exactly how much of risk we're willing to take. Now, if you're not willing to take that risk, you shouldn't put on the trade. If you're not willing to put on the trade, you shouldn't be trading. Right? Take a step back. Right? Am I willing to find out? Let's go back to this. Am I willing to pay $503 to find out this trade is going to work? Yes. Then continue on. If I'm not willing to pay $503 to find out this trade is going to work, am I willing to take any trade? Well, yeah, but I'm only going to take the trades that work out. I'm only going to take the trades where I'm going to win. What? That's so dumb. What, Chris, why would you even take a trade that's not going to work? Duh. All the other YouTubers know that. I just saw the video where this one guy put out his 5 stock picks for the year. I'm just going to buy those because he knows that they're going to go out. All right. He knows exactly the price. He's seen the future. He got access to the Nancy Pelosi plan in TradingView before everybody else. And because of that, I'm not willing to risk $500. I'm only going to make $500,000. Duh. What an idiot accounting for risk. Sounds like Chris Chains. Chris Chains is not coming today. He's already shown up once today. He's not coming back. So professional investors focus on risk. We talked about that earlier with Mark, right? If you're not willing to take the risk, you're not willing to be a trader. It's just the truth. And this is not portfolio sizing. This is a different concept here. Risk position sizing is not portfolio sizing. The portfolio allocation will be larger than this. Now you're going to love this, right? So you can actually take huge trades, yet small amounts of risk. And if it works, then you've got enough size working for you. Back to what Mark was asking earlier. Mark, I'm really glad you asked that question so we can keep referencing it. So you can take a big enough position size to count. But if it doesn't work, it's small enough because of the risk that you assigned early on that you're going to be fine, right? So you can keep your risk consistent, but not the size, meaning you can't buy 100 shares in any one of these and just be like, no, it's fine. I bought 100 shares. No, it's totally fine that I bought 100 shares of each one of these. No, are you kidding? Some of these Like you could take 50% bigger. You could go 50% larger on that. Just like I increased the view by 50%. Some of these, you need to go 39 shares, not 100 shares, right? If you kept your share size at 100 across the board here, your risk is all over the place. Your risk is going to be all over the place. And we're measuring risk. We care about risk. And we remove that variability by sizing using the ATR values. So all the stocks in this example will have the same risk in dollars. I just showed you that, but wildly different position sizes. So remember, higher ATRs equals lower position sizing, and lower ATRs equals higher position sizing. And that allows us to still have consistent risk. So let's go put this together. And let's say, let's actually get real dollars on these, right? Hang on, let me log in a trade here real quick, and we'll actually get some real dollars on these. I think this will be really interesting once we get this through. I love the fact that I totally butchered my spreadsheet as I'm trying to show the spreadsheet and talking about how it's going to be right down below. How perfect is that? What wonderful timing that is. Start live trading. What wonderful timing that is. Okay, I've logged in. I didn't want to show you that my password is monkeyhammer69. So we're good to go. So what we're going to do is we're going to go to Cake, Celsius, Elf, Gold, Silver, Google, and Intel. We're going to get the price per contract of these. And while that's loading in, there we go. That's the US investing fund right there. Let's go back to, let's do 5% risk just to make it more fun. Why not? Because it's better than one contract here when we can have more than one. Okay. So let's go over here. And the first one we're going to look at is Cake. Now, these may or may not fit my my personal criteria, but I'm just trying to use examples here. Let's say we go to February. Let's say we go to this one right here. So Cake, 52.5 in February, 73 delta, $5.90. Okay, so we can go here and put 590 price per option contract. Now, don't get excited. Let's get a couple data points in here. Let's go to Celsius. Let's go to February. Let's go to this one here, 855. Let's go to Elf Beauty. And while I'm typing this in, if you guys have any questions, just go ahead and shout them out as I'm typing this in. $20.50.
Chris, if the actual option delta is like 72 or 73, would you ever go back into your spreadsheet there and update that so that it'll give you a more accurate option contract size?
William, you absolutely could. 100% could. I am a horseshoes and hand grenades kind of guy. If I'm in the ballpark, I'm good. I don't have to be so pedantic in that case. It'll take care of itself. Does that make sense? But you totally could, dude. And if you're the type of person who wants that level of detail, by all means, do it. By all means, do it. I'm not going to stop you at all. Is that something you would rather do?
Yeah, I'm a little bit anal retentive, so I'm sure I would.
Probably can go to the doctor about that, my friend. Especially the anal part. Let's go 1135. Just playing with you, my friend. Let's go to Google. We're almost done here. Better than digging ditches. I'll put it that way. Let's say 3735. And last one is Intel. $7.35. Okay. Cool. So let me delete these other ones that we don't need. And to William's point, you absolutely can adjust these. You could do like 72 delta. You could do 84 delta. Whatever the case is, by all means, go for it. But that's my ballpark. That's where I live. So I just keep it there. Okay. So we can see here that the price per contract can vary wildly. This one is literally 8 times more than this one, right? But yet we're still going to have the same amount of risk. This cotton picking Texan who has no idea what he's talking about is telling me that I can buy 5 times as many shares or options in this case and this one's going to cost 8 times less than that one, and all the risk is going to be the same. He is out of his ever-loving mind. But it's the truth, because we've established how much risk per share we're willing to take between the current price and that amount of risk, right? $3 on the $56 stock right there is going to give us $2,517. That's it. It doesn't have to get overcomplicated. But now we've gone through and we've added in all of these together, and you guys are going to love this, right? If I were to do that much risk on Cheesecake Factory and I took 835 shares, that would be all of my account. That'd be 100% of my account nearly, right? If you took $56 times 835, that's going to be 94% of this account. 94% of this account. This one's 160%. Gold at $411. And if I bought 197 shares, that's going to put me at 160%. This guy is crazy. That's why we use options, because of the leverage. We're going to talk about options more later. We'll talk about exactly why it's the best hack that you could ever come across. But by going deep in the money options, we can nearly have the exact same risk to return profile here, yet pay significantly less. Significantly less. So I could put all, how many is this? Count. I could put all 7 of these on, and it's 90% of my account. Where I could not put any single 2 of these together. It would be more than my entire account. This is why we use the options, because it allows us to take more trades, right? We get the capital efficiency that we're looking for. We're able to take advantage of that leverage and let it work for us. And when it's not working, we just get out of the way. Now, I didn't come up with this on my own. I mentioned this. I learned this from a billion-dollar hedge fund manager. This is exactly what he did in his billions of dollars. So he could take a 90% position size across 7 trades, giving him additional diversity, lowering his risk overall. And let's take a look at this, right? If all goes to hell and we lose 100% of this, like it goes from $5.90 a contract to 0, that would take out 11% of our account. That would super suck. We don't want that to happen. We're going to get out of the way before it goes to 0. This is not a binary event. This is not a all or nothing. We're trying to maximize these gains, and if the losses come against us, we might get out at $5 or whatever the case is. But we have understood that this is the amount of risk it's going to cost us to put on these trades. That makes sense? Everybody following? Everybody tracking? Cool. I won't belabor this point anymore. Let's keep going. Notice that the position size relative to the portfolio size. That actually was one thing I was trying to get at. Position size relative to the portfolio size. Okay. Position size, we're taking 5% of risk, yet we're able to take 11% of our portfolio. That's actually the number I was looking for. 5% of risk, and yet this is 10% of my portfolio I'm putting into it. So we can take big positions, but we're not going to let those positions go to 0. Okay. Let's keep going. Notice you can get many more trades on using options and stock for the same amount of risk. Tighter stops equal a bigger size, and looser stops equal a smaller size. That's what the ATR represents. Now, how about some rules for management and survival, risk management and survival? You got to keep your risk consistent. That's the number one rule above all this, right? In order for your edge to play out, you must assign a limit to the amount of losses you're willing to take, and then not let it eclipse that amount. If it goes over that amount, things happen, right? There's nothing you can do sometimes. It gaps through your stops, and you got to take your lumps. And that's why we have a average win and an average loss. We always want our average win to be as big as we possibly can, and our average loss to be as small as we possibly can. If you size up, you do so gradually. I've talked about this before, but if your quarter Kelly comes in at 20, oh no. If your Kelly comes in at 30% like Rick's did, Rick was such a baller. He came up with a strategy that had a 30% Kelly criterion. And he's like, that's it. I'm doing full portfolio. Let's go, baby. I'm only going to risk 30%. Nah, it's not going to work out very well. But let's say he went with like 1/3 Kelly. That'd be 10%, which is still big. Maybe he went 1/6 Kelly. That would be 5%. Okay. All right. 1/6 Kelly makes sense at 5%. And do whatever fraction you want to, right? We're just trying to identify, like, if there was an ideal, which the Kelly quote is ideal, we're trying to get close to that without risk of ruin. Okay. So let's say Rick is at 5%, and that's where his quarter Kelly's at. But he's not been trading all that long. So he's starting at 1%, getting his feet wet, understanding how it goes. He's taking 6 months to really understand the processes. He's proving to himself that he can follow this plan. And then he goes up to 2%. He can afford that, right? And then he gets used to that size. He goes up 6 months later to 3%. And he goes up 6 months later, maybe to 4%, maybe eventually to 5%, right? This is a gradual thing. And I want to always tell this story. I know I've told this story before, but MikeyMike, one of our alpha students, was doing everything right. He had 1% position size and was killing it. He's like, Chris says I can go 5%. I'm gonna go 5%. The first trade at 5%, he lost all of his gains from the 1%. He didn't do anything wrong. It just happened to be the roll of the dice on that one came up as a losing trade, and he felt like he effed up royally. But he didn't. It just happened to be a losing trade, which losing trades happen. It is an unavoidable part of trading, just like winners are an unavoidable part of trading. And had he gone from 1% to 2%, you might not have even noticed. But because he went from 1% to 5%, that was a big shock, a huge shock. So Mike, I hope you're watching. I love you, dude. I'm sorry that it happened, but it really is one of those lessons we can all learn from. Treat your stop losses like they're written in stone, and never, ever, 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 ever under any circumstance move your stop down. If you're going to move your stop, it goes one way. It goes one way, and that's up. You're not ever allowed to move your stop down. Remember, losing is an unavoidable part of trading, just like winning is unavoidable. The difference is how you handle it. Now, I'm asking you guys, what are some rules that you can think of that we can use for risk management? I'd love to hear from you. What are some rules you can think of? Art's got one. I know Art has one. He's been sitting on his hands the whole time, like, let's go.
Yeah, so I think one thing's a comment on it. I think new traders struggle with that the getting out of a trade. I mean, it's tough to say and pull the Band-Aid off and rip it off and just say, okay, I'm done. I'm moving on to the next one. That's for new traders. That's super, super hard. I know it was for me for a year ago. It was tough just to get out. So I think that's a problem. The other thing is, you know, I struggle with the 2 ATR, and I think it's too big. And so I've been setting it at 1 ATR. And what it allows me to do is get more options that way. And I think that gives me more ability to go on the upside. And if a trade's going to go against me, it's going to go against me, and I'm getting out. And you just got to, you know, it's got to be, I trade an hour before you do usually, because I want to watch the live stream and not have to worry about making trades at the last end of the day. And yeah, so I think the big rule there is you got to get out when your plan tells you to get out. You have to get out. You just have to do it, and I think that's tough for new traders.
It is. It really is. And look, I agree with you on the 2 ATR stop being really wide. I really, really do. I did half ATRs for years. That was 1/4 of that. Okay. But what we found through the backtesting data was that it was so tight that I didn't give the trade enough room to move before it actually would take off. And that's just part of it, right? And so accordingly, that allows me to position size to the 2 ATR stop and still maintain the same amount of risk, right? Because I'm willing to take the risk to the 2 ATR stop. That's it. That's all I got to know. And if it hits the 2 ATR stop and I get out, is what it is, right? You've seen me do it.
So if you're a new trader, and you're only working on 1%, and you can only take one contract, would you recommend a new trader, somebody new with a small account, go at a half ATR so they can get larger contracts than trying to force that 2 ATR and only have one contract at a time?
This is going to sound really out of touch, but I would recommend not trading at all until you've got $20,000. Now, where do I get 20,000 from? Once you get to 20,000, you can actually get like decent numbers in this. instead of everything, like I'll overwrite this. Everything's going to basically be one contract. I mean, sometimes you get a couple more, but everything's going to be basically one contract, especially if you're doing 1% risk at 20,000. At 20,000, that's when it starts to actually like show different numbers here. Because let's rephrase that. If this was 5,000, it will always be one contract. Because it will always be one contract. Your risk is not going to be in check. It's just not. Because you're not going to be able to have 18, so 1/18 of a contract versus 1/83 of a contract. That makes sense? And so, and I trust me, I get this. But if you have less than $20,000, you don't have enough in there for the risk to actually balance out. So what I would suggest is save your face off, do everything you possibly can, start driving for Uber, start doing all the side hustles you can and save up money. And in the process, you're going to be proving to yourself through paper trading, through back testing, through Monte Carloing, through doing all the simulated trading you possibly can that your trade is going to work. And then when you jump in, you got $20,000 and you take your first loss on your first trade, you know, it's part of the game. It's just part of the game. Right? So I know, listen, I get it. Some people, $20,000 is like an impossible goal for them to set. But if you don't have that amount, you can't spread out the risk accordingly. And if you took all 7 of these, right? Some of these are going to be great winners. And some of these might be really, really hard losers for you, right? Because you really aren't going to be able to control that. Does that make sense, Art? Yeah.
Yeah, absolutely.
I mean, if somebody had told me that, I'd be like, I'll show you. And then I blow up my account. So what can I say?
I jumped in the deep end and went at 5% right away. So I just, you know,
yeah.
I'm a 5% guy. I like that. That's a good number, and that's where I'm at with it. So,
and that's okay, dude. If you want to start at 5%, then you don't have to stress about loading up to 5%. But just understand, like, your first 5% loss is gonna hurt. It's gonna hurt real bad. You're gonna be like, ooh. Do you guys? Well, y'all have traded for a while, but the first time I had a like 5-figure loss, I was like, that hurt. Oh man, right?
It takes a while to get over that. It takes the psychology of trading is a big part of this, and getting over that loss, that first loss, is tough. It's tough for people, you know. But after you've done it for a while, it's just part of the game. You just keep on to the next, right?
Yeah, for sure. That is part of the game. Losses are an unavoidable part of trading, just like winning is. Right. And we showed in our Monte Carlo over here, right? Even the best case outcome had 13 losing trades in a row. In a row. Are you kidding? By trade number 3, most people have said trading's a scam. I can't do this. I've lost all my money, because they don't understand this is the reality of trading. That's why we have consistent risk. Right. What's up, Stocky Locky?
Just to add to that one, it's 13 losses at 5% is going to hurt.
Yeah, it's going to hurt a lot. But would you say 16 wins at 5% is going to hurt? Probably not. You'd be like, hell yeah, let's go.
It's just interesting, isn't it? How much of that
control.
It's just interesting, isn't it? How much of your portfolio can just on the Monte Carlo can just disappear effectively, but still be profitable in the long run, which is what I love.
But that's if you don't panic sell. If you lose, if you jump out because you're scared because the market, you know, didn't do what you told it should do. I mean, like, it's just never gonna happen. If you said these are my top 5 stock picks for 2026, and then Celsius, you're hopped up on Sudafed and Celsius tanks, right? What are you gonna do about it? Just gonna panic? Or are you just gonna say, you know what, that's part of the plan? I always knew I was gonna have losers. That is the mindset of a professional investor, a professional fund manager. I know I'm going to have losing trades. Does it bother me? No. Why would it bother me? I know I'm just as likely to have winning trades. In fact, I have a 56% chance of having a winning trade versus a losing trade. it bother me? No, of course not. Even if you had a small or if you had a strategy with a low win rate, not a small win rate, but a low win rate, yet it had positive expectancy, who gives a flying flip? Just run that until the end of the earth, right? If you flipped a coin and every time you flip that coin, you won $1 if it landed on heads. And every time you flipped a coin and it landed on tails, you lost 99 cents. That's not a huge edge, but you should flip that shit forever. You can literally make billions and trillions of dollars if you flip that forever with a 1 cent edge. That is what we're trying to do here. Find an edge, exploit that edge. That makes sense? What else on y'all's mind? What's up, William?
This is actually off topic a little bit for the lesson, but we have some like stocks where sometimes we'll look at the option chain, and I know you always try to aim for 80 delta, but like let's say you're going to buy a stock that like Tesla's in the $400 some range, you're not getting an 80 delta option for the price that you want to pay, you know, 10 or 15 bucks per share per contract. Would you look at other deltas? I mean, you might end up at like a 20 or a 30 delta in order to get into the price range that you actually want to get. Or are we kind of cutting ourselves off from being able to trade that because we want to keep our risk lower?
I mean, it really depends. At one point in time, I did have a $10 cutoff. And I mean, there were plenty of trades I didn't take just because it was greater than $10. I've kind of removed that now, and I'm open to whatever it costs. But you'll notice when it gets to $30, $40, it's not going to be very tight on that bid-ask spread. You're going to have huge bid-ask spread. So that kind of like throws it out the window anyway. And no, honestly, I'm not leaving in the money to go out of the money, right? Can you? Yeah. Can you be successful? Probably, right? But it now adds additional complexity that you don't have to have, right? All the theta working against you, everything else that goes into the Greeks, right? When you can remove that and just focus in solely on delta moves, which is what we're trying to do at the end of the day, we're trying to narrow in on just delta moves. Then it gets a lot simpler. But going out of the money, you introduce a lot more variables.
Along those lines, I noticed that going to some of the lower 70s, upper 60 deltas, depending on what the open interest is and and whatnot, the whole situation when you look at the option chain, like sometimes it's worth doing versus not taking the trade. Just you're not going like too shallow or on the other side of the equation. But if I can't get the 80, if I can get the 72 or the 68, still makes sense. I'm going to do it.
Yeah,
and it works
for sure. Yeah, I don't have a minimum. I don't have a maximum delta, right? And we'll definitely talk more options later. If somebody's watching the Bravo replay and they've never traded options, they're gonna be like, "What the hell are these people talking about here?" We haven't even got to options yet, but you guys are super smart. You're very advanced. There's no minimum, no maximum. It's just 80's the ballpark, right? In the ballpark, right? On third base is going to be 68. On first base is going to be 94, right? Somewhere in there, right around that 80 delta. That's right, Art. That's right. There was a great question that came through the chat, and I wanted to address this. Jeremy, the MVP, 7,000. It's not Jeremy, the MVP, 6,004. It's Jeremy, the MVP, 7,000. I like that. He got the new upgraded model of the MVP. Since we're talking about risk, can you speak on the potential risk exposure to taking a bunch of trades in one sector? So think of it this way. If you were trading the Magnificent Seven or the FANG stocks when they were having their big, beautiful runs, would you say, I'm overexposed to these guys. Maybe I should be in different sectors. Maybe I should have a little bit of oil. Maybe I should have a little finance. Maybe I shouldn't be so concentrated in tech and communications. Probably not. You'd probably be sitting on all those gains going, hell yeah, this is amazing. I can't believe I was so smart to pick these 7 stocks that only go up, right? That is what we need to consider when we're talking about sectors. We are looking for the hottest sector in the market. We identify that using the outlier data. Because we're looking at the hottest sector in the market, that's where the money's flowing. If you got a greedy market in a greedy sector and you're finding the greediest stocks in that sector, that's exactly what you want. In fact, back in the 1950s, I rearranged my books. My top 5 books are always going to be up here now, so it's easier to reach because this is one of them. This book right here, How I Made $2 Million in the Stock Market, was written in the 1950s. That's exactly what he did. He would find the sectors that were on fire, and he bought every single stock in the sector. And then when they didn't work, he just sold it, and he kept the others. And when it stopped working, he'd sell it. And then when that stopped working, he'd sell it. And then at the end of the day, he'd only be left with the biggest, most beautifulest winners ever. That's the point of getting in a hot sector, is because it doesn't work for you. 40% of the stock of move of any stock is due to the market. 30% of any stock is due to the sector. You want those hot sectors. Hell yeah, I want to be concentrated as F when a sector is on fire, because then I can take advantage of all the gains. And if they don't work, we just cut our losses and we move on. Does that make sense? That's not the traditional finance take on this. You got to diversify across the asset classes. You got to diversify and have hundreds and hundreds of stocks in your portfolio. The truth is not the case. Concentration is actually what yields huge gains. Mark Minervini is huge about concentration. I don't remember where I've heard him say stuff like that, but he it's probably in his books, talks about just how important it is to be concentrated when those times are happening. You want to be concentrated AF up in those. That makes sense? You're welcome, Jeremy, the MVP 7000. Kashi, I think you had a question. What's up, dude?
Yeah, interesting. You know, I listened to your videos about the position sizing and the risk, and I think it just now kind of really kicked in, like looking in how the Monte Carlo behaves, and the fact that it sort of predicts, or shows that you can have, let's say, 3 to 13 losers in a row, which really you can almost feed it back into your position sizing from, like, Kelly position sizing. So if you want to have 10% position sizing times 13 losses, you're going to be at negative by the time for the 10th one.
Yeah.
So you really got to understand, like, are you, let's say, even if it's 5%, are you really willing to go 75% deep? 75% deep is a lot.
It is. But
So
also that ended up being the biggest trade ever.
The biggest trade, sure.
Yeah.
It was more of a revelation that, like, you should, for yourself, balance your own risk with what the math tells you, and whether you can psychologically handle the kind of drawdown before you say pencils down. I can't do this. Right?
Yeah. I mean, there are times where it's going to feel like you've done everything wrong, dude. Did you follow my trades last summer?
Mm-hmm.
I think I went through 13 losing streaks. I think I did 13 in a row.
Yep.
Yeah, it sucked.
Mm-hmm.
But it was also part of the game, and I still ended up fine for the year.
Yeah.
What's up, Stocky Locky?
With the portfolio sizing, just talking about that stint in the summer.
Yeah.
So I just tweaked on then. I never put two together. Obviously, when we did the portfolio sizing, it was 2 ATR. So we did a 2 ATR as the element with, so you do portfolio multiplied by your risk, divide by 2, multiply by the ATR.
Mm-hmm.
But then we'd always put originally it was the half ATR as your stop loss.
Mm-hmm.
So you never ever risk that full 2 ATR. It'd be a quarter.
That's correct. Yes. That's what this number represents right here. Base risk per trade and then max account risk per trade. Your base risk per trade is 1/4 of that. Yes.
So I was, because when we were losing, I was like, oh, well, it's less than what I was accepting to lose for the trade. So for me, that helped with my mindset with the planning. I thought, well, as long as I keep sizing it like this, if it goes against me, and that's obviously because it was a quarter of what I was originally willing to accept to lose, but then when it was going for me, great.
Exactly.
It's only just twigged then what was going on in my head back in the summer.
You're good, dude. It's what Steve wrote here. Those 13 were probably below average. They were not full losers. Right? And that's kind of what you're saying, right? They were below average, right? This is the average loss. Right? The average loss in ATRs is 1.4. Now, I don't have the data on top of me that says how many were the full losing trades, but the average loss is 1.4. So should your stop loss be at 1.5? It could be. It could be for sure. But also I find this data really interesting, right? The average down move at any point in time during a winning or losing trade, the average down move would 0.42 on a winning trade, but yet it ends up with an average up move of 3 ATRs. And then on the losing trades, the average down move is about 1.6, with the average trade ending up at negative 1.38, so about 1.4.
Do you think with that, the half ATR, with a max drawdown for the positive, that is such a tight, such a close margin?
Yeah. And that's why a lot of my winners didn't materialize. I was the one guy who lost money on SoFi last year, and the one guy who lost money on NVIDIA, me and Art, just us two. We were the only two who lost money on that because my stop was too tight.
So the fact that some losers have positive like 0.6, that means that you had an exit signal, but they were still up. Or something else.
Let's draw on a chart.
I think that means it went up before it reversed on itself.
Oh, I see.
Yes, exactly. Yeah.
The average move was that higher.
Yeah.
Got it.
Yeah. So it went, I'm trying new tools over here. It went something like this. It went up half an ATR and then it ended up going down and then not working out. Right. Or maybe even it even went down and then came up and then went back down again. Something like that. Right. That's what that means.
Well, it's kind of where the half ATR roll came in too, right?
Yeah.
You know, so
exactly.
Even if we go off the half, we grab that like that little gravy and then call it good.
Take as much risk off the table as you can right away. So that is what that new half ATR rule is for. Because on average, even the losing trades go up half 0.6 ATR. But remember, at that time, when we're making this first roll, we don't know if it's going to work. We just see the data in front of us and say, okay, you know what? Here's a chance where I can take a little bit of risk off the table. I can keep the trade on. That is the point of doing it, right? It's always to minimize risk. Hang on, somebody mentioned something here. We talked about concentration. Warren Buffett says that diversification is for people who don't know what they're doing. So you can be concentrated as possible in a sector if you understand what you're doing, right? Stanley Druckenmiller, who is George Soros's partner at the Quantum Fund, I believe is what it was called. No politics here. George Soros and Stanley Druckenmiller made trillions of dollars, right? One of his quotes was, put all your eggs in one basket and don't take your eyes off that basket. I'm politics aside, I totally believe in what he's saying right there. So this has been great today. I really think you guys were embracing this. This is great. I'm very proud of y'all. Let me see if I have the plan for next week just yet. Sometimes, I don't know if y'all know this, but sometimes the teacher is like, shit, I got to do slides real quick. Next week is options. And I love options. We're going to do options basics. Then we're going to do advanced option concepts. I'm going to nerd out like crazy. It's going to be like between options deep dive Wednesday and Bravo classes being all about options. You're going to know more about options than you could ever want to know. Doesn't mean that's going to be great, but you're going to know. I'm also going to see if I can get Lex. I just met with Lex yesterday from Tradier. He is their chief content officer. I'm going to see if I can get Lex on either next week or the week after, because Lex knows more about options than I thought I knew a lot. And then he was throwing stuff at me. I'm like, well, I never knew that. So I'm very excited about that. That'd be great. Okay, I will get you guys out of here. I know it's late. Thank you guys so much for coming. But listen, if you're not a Bravo student and you are interested in saving time, making money, and starting winning with less risk, but you didn't know where to click specifically on the screen, where do you think they should click? You're right there, and then do the little finger dance. And you guys are awesome. Thank you so much for coming. Really appreciate all that you do.